Wonderful. So with that, a very warm welcome to our kickoff session for the Spencer Virtual Campus. If you're not familiar with Spencer, we are a nonprofit organization that supports the future leaders of our industry, which is everyone that is in the virtual room today. College students who are interested in careers in risk management, insurance, and actuarial science. We support students and universities through various programs such as scholarships, grant programs that support experiential learning opportunities, and of course, our annual International Risk Management Challenge. We do have an amazing guest speaker that is here with us today. We have Alex Korb, who is an alternative risk transfer consultant, and he is going to share some knowledge on parametric insurance. So thank you for being here today, Alex, and I will hand it over to you.
Many thanks, Tandaka. Really appreciate it and delighted to meet and see everybody today. Alex Korb, I intend for this to be an interactive session, guys. So anytime you ask questions, please either get off mute or type it in or raise your hand. I probably won't be monitoring it because I'll be too busy focusing on what I have to convey to you, but I'll kindly ask Tandaka to obviously interrupt me as we go along just so that we can get the maximum value from this session. So, look, the good news, I don't have any slides. I'll talk. If I talk too fast, please let me know, slow me down, because the goal is to hopefully have at least one of you leave this session today with a deeper understanding and appreciation of why every self-respecting risk manager and insurance professional in college or otherwise should be at very least aware of what parametric insurance solutions are and how they can significantly narrow protection gap. I'm sure you heard that buzzword many times before, and this is what we're going to be talking to you about. Now, I don't want to assume how many of you have heard of this or know something about it. So if something I'm sharing is repeating what you know, well, sorry about that, but hopefully not. So with that, let's set the stage. In defining what the hell that is, right? Parametric insurance. Now, those of you who've heard the term or perhaps even read something about it may have come across numerous explanations and different definitions, ranging from, oh, this is basically an if-then statement, or this is pre-agreed payments, and so on. And they have absolutely a share of truth to them, but I don't like them. And so I'll give you my own definition of what parametric insurance is, focused on what I think is the crucial element that separates it from traditional insurance and the huge benefits, albeit sometimes subtle, that that differentiation brings to the market, specifically for risk management, hedging, and so on. So parametric insurance, I call it insurance 2.0. And you may have suspected that insurance 1.0 then is our traditional existing indemnity insurance, which has been in this format for centuries, since the times of Lloyd's of London and even before. Spoiler alert, I also have insurance 3.0 and 4.0 in my nomenclature, but that's for another Spencer webinar, assuming that you have a good feedback on this one. All right, so everybody, I'm assuming, familiar with traditional insurance 1.0, which is focused on physical damage. I'm sorry, I should clarify. Property insurance, right? Because obviously lots of types of insurance, life and health, etc. We're not talking about that. We're talking about property and casualty insurance. And so whether you're talking about personal or commercial, the contract language will say you have to have a physical damage to your asset. And if you don't have a physical damage, guess how much you're going to recover from the contract. You're going to recover zero. Okay? So here is my definition of parametric insurance. It's an insurance without loss adjustment process as we know it. Let me pause here. We all know, and hopefully maybe some, well, not hopefully, but some of you perhaps even had a first-hand experience with traditional insurance loss adjustment process, whereby, especially after the major catastrophe, it could take a while to adjust your property claim on a house or what have you. Part of it is just a reality. If, let's say, in the aftermath of Hurricane Katrina in 2005, there were well over 1 million claims. When you have that many claims, even if you have so many insurance companies, somebody is got to be last in that queue, right? So that's just part of it is just reality. Part of it also is the nature of loss adjustment process in traditional insurance is by definition, it is subjective. It is oftentimes contentious. It could take long, long times, months, sometimes years, and in a few limited exceptions, decades to litigate commercial claims. And as I just hinted, it could involve litigation. So this is traditional loss adjustment process. And what I've just defined, parametric insurance doesn't have that, which probably begs the question, well, then how the hell do you get paid under parametric insurance arrangements? So now, imagine what I've just discussed, all that work, subjectivity, potentially contention, litigation, and extended duration for ascertaining how much you can get paid, if anything at all. What if all of that work is effectively front-loaded, moved up front, not at the time when the claim hits, but before you actually sign the contract? And that's what parametric insurance does, right? You pre-agree on specific amounts and specific conditions when you're going to get paid. But it takes it one step further, and it's a very subtle but important step. It takes the loss adjustment process as we know it away from a bilateral relationship between you, insured, and the insurer, and takes it outside and makes that settlement based on some independent, objective, third-party data source, right? Let me give you an example because stories are always compelling. And by the way, so I'll give you one particular example right now, but then later on as we go along, assuming you don't pepper me with questions in the interim, I'm going to ask you to throw out different industries to which I will hopefully be able to find and articulate concrete examples of how parametric insurance solutions apply to different industry around the world. So here's an example, perhaps to bring home that subtle distinction of pre-agreed settlement based on independent data source. Say you have a hotel on the Gulf Coast. And it doesn't really matter whether that's a Gulf of Mexico or Gulf of America, a little bit of a political joke there, but let's say it's on the Gulf Coast, and let's say there is a hurricane that just happened to pass nearby, and miraculously, whether because your hotel was built to last or otherwise, you do not have any physical damage, not a single shingle off your roof. So perhaps a rhetorical question to you guys. If you have a commercial property insurance policy for your hotel, how much are you going to recover from that policy? Any guesses? I see only a few faces, the rest of you names, but because I said it was a rhetorical question, the answer is you're going to recover exactly zero because, remember, traditional insurance inextricably links recovery to the physical damage, to the physical asset that you have. And since your hotel miraculously was unscathed by the hurricane, you're going to get exactly zero. Now, let's look at this hotel and its financial damages. So even though there's no physical damage, let's say for the next 3 or 4 weeks, the hotel is virtually empty because folks like you planning to vacation there stay away, either because you think that, oh, it's right in the midst of the hurricane landfall, so it's probably a mess over there, rightly or wrongly, or because in reality, there is a wider area damage. Maybe there is an airport that is flooded. Maybe there is a wide area destruction around the hotel. And so for various reasons, your hotel suffers significant revenue loss because customers stay away for weeks. And you have to advertise and you have to maybe run an extra marketing campaign and say, hey, guys, we cool, come over. We open for business. So this is an example where hotel suffers significant financial loss or economic loss, whatever you want to call it, and yet not a single physical damage in a traditional sense that we all might be accustomed to. So in a traditional insurance, you're going to get exactly zero, and yet you're looking potentially at 30, 40% drop in business, right, for an extended period of time. And that's where parametric insurance comes in. So here is a parametric solution that hotel should have put in place. The solution that will say that if, let's say, there is a hurricane of category 3 or higher, passing within, let's say, 30-mile radius of our location, we want to get compensated X. I'm simplifying here. The X could be a lump sum amount, or it could be a graduated payout, which is calibrated to your hotel-specific experience. For example, you may say, you know what? If it's a category 3 storm passing within a 30-mile radius, chances are we're going to have, maybe a few palm trees, uprooted and some other things. So we estimate that damage is going to be X, right? We want to get paid for that. maybe at a higher category event, or if it passes by closer, you think, well, you know what, chances are in that case, we're going to have disruption to our major roads, and our employees won't be able to come in. So that's going to be a higher expense for us. So we want to get compensated. Why? So you do all that legwork up front. And then you have a policy that says, if that event happens, you're going to get this much. And if the wind blows at this speed, you're going to get this much. Everything is clear. Everything is agreed. But more importantly, there is no contention there, because that settlement would be based on objective independent third-party data. For example, it could be based on the hurricane track published by National Hurricane Center, which is publicly available, and you can see that. Or it could be based on wind speeds, which again, you can see from the publicly available data from National Weather Service or National Oceanic Atmospheric Administration, etc. Just as an example, right? And so let me actually pause here, right? So this is the difference, right? Having a traditional policy which requires physical damage and having a parametric policy which focuses on much broader impact, right? So remember, in that example with hotel, you don't have a physical damage, but you suffer financially, right? So this is much broader financial impact than just a physical damage. Now, physical damage could be part of that impact. It could be a small portion of all the impact, and the larger impact could be financial economic loss stemming from the business interruption, or actually more precise terms, non-damage business interruption, and so forth. But it could also be physical damage, could also be part of that. And so a couple of things as you trying to conceptualize parametric versus traditional indemnity, or 2.0 versus 1.0, if you will. One is traditional focuses on physical assets that you own. That's an important distinction I'll mention in a second. Versus parametric focuses on much broader impact, right? Much broader impact, of which physical damage could be a portion, but it is much broader than that. But let's talk about benefits, sort of the subtle benefits of moving the traditional loss adjustment process outside of that equation and effectively having it pre-agreed based on external data, as opposed to subjectively determined and litigated over extended period of times with an insurance company. There are several, well, typically people in the industry talk about 3 major benefits of parametric solutions. I'll double that. I'll give you 6. That's a bonus today. Buy one, get one free. All right. So the first benefit is this. It's very fast. For example, once an event happens, either a particular wind speed or hurricane track or seismic intensity of an earthquake, what have you, those objective parameters, typically, whether they're published by public agency, whether they're private but still accessible to both parties, they're published and they're available very, very fast. And so typically, with parametric insurance, at least in the majority of the contracts, people will say that you're going to get that money at most within 30 days. In reality, some payments could be as quick as a week. And in some cases, the payments could be made in a matter of hours. And I'll give you some examples of that as well, right? So the first advantage of parametric solution versus traditional indemnity is very fast payment. In case you're wondering, who cares? Well, small businesses and many of us owning homes and what have you, we do care, because $1 today is much better than maybe $2 a year from now, after pain and suffering and aggravation of litigating and arguing with it, right? So this quick injection of liquidity, especially for small businesses, oftentimes means whether you stay open or whether you shut your doors, because the payment that you may receive months or years down the road under the traditional contract will be a little too late, right? So speed is number one example. Number one advantage, right? I should say hallmark. Let's use that word. Number 2, again, in no particular order, transparency. Again, go back to the traditional insurance example. Your adjuster comes in, gives you an estimate. You don't agree with it. How did you come up with that number and all that stuff? Whereas with parametric insurance, there is no black box when it comes to justifying the value. It's all clear and it's available both to you as a buyer of insurance and to the seller of insurance company. In that example that I gave you was a hotel on the Gulf Coast. If the payment is contingent on a particular wind speed, then that wind speed will be referenced to a particular weather station. Both of you can, track it in real time on a website. So there is no, he said, she said. It's one source of truth. And so that transparency is very important as well. So that there is not really a basis for disputes. Let's put it this way. Third aspect, which I sort of already alluded to. Parametric insurance provides, by design, a very broad cover. Meaning, traditional insurance only focuses on physical damage. No physical damage, no recovery. Whereas, as we just seen from that example with a hotel on the Gulf Coast, the reality of today's world, especially in our service-dominated economy, is that a lot of damage and negative financial implications from weather and disaster events had nothing to do with physical damage, but has everything to do with decrease in traffic, like a customer traffic and interruptions to the supply chain and various other things, which are very detrimental financially, and yet not accounted for by traditional insurance. So that broadness of cover that parametric insurance provide, again, you may recall I earlier emphasized, think parametrics, think impact, overall impact from a particular disaster, including physical damage and non-physical damage, whereas traditional insurance focuses on physical damage only, right? Let me give you a couple more. By the way, guys, if I'm talking too fast, please let me know somehow through Tandeka or otherwise. Another important aspect of parametrics is flexibility. What I mean by that? So we all been following the tragedy that's unfolding in LA with wildfires, and perhaps you've read in Wall Street Journal, some other publications, a very unpleasant dilemma facing many people in Pacific Palisades and elsewhere, whereby they have to make a choice. Do I rebuild? And if I rebuild, and I'm lucky to have an insurance, right? Insurance company presumably will cover all of my rebuilding costs, including, upgrade to the newest building codes, etc., right? Do I do that? Or do I just say, forget it, I had enough, I'm going to move whatever? In that case, you're not going to get 100% of your policy limit. If you do not rebuild, you do not get 100%. You get some discounted value. It is, I believe there is a notion in the industry, it's called holdback, which means that, portion of the proceeds will be paid to you once you actually rebuild, right? And if you don't, then you do not get to receive the 100% of the insured value of the house, right? And so with parametrics insurance, there are no strings attached, meaning, let's go back to that hotel example on the Gulf Coast. So let's say a particular wind speed was registered at your location, or maybe the hurricane passed within a defined pre-agreed radius of your location, and you collect the money. And let's say you collect this money according to the contract, let's say 10 days after that happened. Nobody is going to dictate to you how you're going to use that money. You want to use that money to replenish the sand from the beach erosion on your beach. You can do that. You want to use it to replant palm trees that were uprooted. You can do that. There are no strings attached. And in fact, to be a little bit provocative, you want to take that money and go gamble to Vegas? You can do that. Okay? So flexibility in that sense is very, very important, right? There are no restrictions on how you can use those funds. Let me mention two other things which are very important, in my view, byproducts. Not a byproducts, but benefits, if you will, that parametric insurance solutions provide. Let's take Florida, not to pick on them, but I was just recently there at an industry event, and there was a lot of discussion around that topic. And that topic is, people are concerned that they do not get a proper credit for mitigation activities that they do. For instance, they may be installing maybe they're flood-proofing or hurricane-proofing their house by tying down their roofs, by installing hurricane-prone shutters, and so on. And they make investment into that stuff, and ideally they would want to see a return on that investment, at least as a reduction in premiums, just so that insurers will account for that. But that's easier said than done. Okay? Now, Here is an example where parametric insurance is uniquely suited to account for that mitigation activities that you, for instance, as a homeowner or business owner are doing. Imagine you have two houses side by side. Let's just say on a Miami shorefront. One house is a bungalow built in 1970s. Right next to it is a house built up to the latest Florida building code, let's say in 2020. Let's say for all intents and purposes, identical square footage, whatever, layout. Now, which house do you think is more vulnerable to potential hurricane impact? A rhetorical question, right? Yes, it's probably the older house, which is not built up to the code, etc., especially if they're next to each other. So, because let's say the newer house was built according to the latest codes that presumably can withstand up to Category 3 hurricane storm, the owner, if he or she chooses, can purchase a parametric hurricane policy that will say, hey, I want to get paid if the wind speed at location of my house is greater than Category 4, which is whatever, 120 miles an hour or higher, I want to get paid. Why? Because everything up to 120, I'm reasonably confident, and my architect is confident that the house is built to withstand up to 120 mile an hour wind. So I don't really need protection, if you will, below that number. Whereas the house right next door to you, which was built in the 70s, it is probably at risk from even Category 1 type storms at 74 miles an hour, right? And so if, just hypothetically, if both homeowners would want to protect themselves on a parametric basis based on the wind speed, one will have to, if they're, if they're doing it properly, one will have to have a contract that will start paying at 74 miles an hour wind, and the other, because they invested in resilience and built a better house, they will have to invest, they will have to purchase contract that will only start paying at 120 mile an hour wind, right? And as you could imagine, just from a pure math and statistics, which wind speed is likelier, 74 miles an hour or 120 miles an hour, right? So 120 miles an hour is less likely, therefore that protection kicking in at 120 will cost less. And there is example of how you can tailor parametric insurance sort of attachment point, that's a language in insurance and reinsurance, where it starts kicking in, where you can really put the money where your mouth is. If you feel your house is weatherproofed, climate-proofed, and you invested in it, don't wait for your neighborhood State Farm agent to offer you discount for that. They may not. Instead, you can do it with the parametrics and attach at a level that corresponds to your mitigation measures. And
So
then,
there's actually a
yeah,
question in the chat, Alex.
of
So that was
course.
actually perfect timing. So the question
Yeah.
is from Vanessa Van Propik, and she's asking, is parametric insurance available for personal policies like your car, your home, etc., as well as commercial?
The answer is yes, with a little proviso. I'm not yet aware of the parametric policies for auto, because for auto, the predominant actually, that's an interesting question. So I'll give you two-part answer. Auto is typically liability portion, right? Although you clearly have, if you have a full coverage on your automobile for collision and comprehensive against, hail, for example, hitting your car and whatnot, sure, I could see how a parametric hail insurance policy could be applicable to your for example, windshield damage, etc. Except that, car, unlike home and fixed assets, because car is by definition movable, right? It's a little bit tricky because there are hail parametric solution that, based on the sensors that are attached to the roof. But with car, it's a little bit tricky, but it's a great question. So the short answer is yes, there are plenty of parametric solutions for businesses. There are parametric solutions on a consumer level. So I was delighted to hear at an event that I mentioned in Miami that one of the panelists said that they have a personal policy, hurricane policy for their Miami home. Of course, when I found out that they work for the major reinsurance company, I was sort of a little bit deflated because, yes, you sort of practice what you preach, right? You believe in the product and you purchase it yourself. But still, yes, there are personalized product parametrics earthquake in California, Washington, and Oregon. There are parametric hurricane policies in Florida and around East Coast by several providers. There is a new generation of parametric tornado policies that you can purchase as an add-on to your homeowner's policy, and the list goes on. So yes, short answer is yes.
Fantastic. And Vanessa has another question that she posted in the chat. So, Vanessa, if you're in a space where you could ask, please feel free to unmute yourself and go for it.
Sure. Thanks, Alex. Great discussion so far. And actually, we got dumped with a bunch of snow in Waterloo, Canada today. So working from home. But my second question was the companies that offer the coverage, do they have special regulatory requirements or where are we seeing these offerings in the insurance marketplace globally? Is it more specialized carriers who just offer this solution? Or is it also embedded like a general carrier or reinsurer could also offer parametric options in addition to their usual offerings?
Fantastic questions, Vanessa. We probably need two Spencerette webinars to cover that, but I'll try to condense that. And by the way, I was just not far from Waterloo last week presenting on parametrics and other things to the Canadian Catastrophe Insurance Conference in Toronto. So look, this solutions, and I think that the crux of your question is what's the regulatory treatment, right? And how are they? Okay, so the beauty of parametrics is that they could be transacted in a number of different formats. One of which is insurance, which could both be either admitted insurance, depending on the jurisdiction, or non-admitted or excess and surplus lines carriers, right? By the way, if any of the jargon or terms that I'm using you guys are not familiar with, please just raise your hand or mention something to Tandeka because I'm not following the chat here. Now, in addition to insurance format, these solutions, especially on the business level, could be transacted as a financial instrument, namely as a derivative, because the economic substance is exactly the same. The only difference is accounting treatment, whether you account for proceeds of the payment as an insurance proceeds or as a financial proceeds and therefore subject to potentially capital gains, taxes, etc. But economic substance is the same. And then, of course, again, depending on the context, and it's a longer conversation, there are effectively embedded parametric insurance solutions where the service is offered as a warranty or guarantee or promise of a particular brand, and hopefully we'll get to touch on some of those use cases there as well. And obviously, Vanessa, the particular treatment varies by jurisdictions quite significantly. For example, in the US, there are some jurisdictions that are very proactive and embrace parametrics, such as Puerto Rico, Vermont, Tennessee has a regulation on that. There is something that recently came out from the state of New York that, let's just say, leaves much to be desired. But there's quite a waterfront there, right? Of course, if you talk beyond the US, these transactions, and this is, by the way, maybe also a good segue into something else that I wanted to emphasize. Parametric insurance solutions have been around, let's just say between 20 and 30 years. But up until a few years ago, they've really been relegated to almost like a backwater or niche market focused mostly on energy, on agriculture, and really, really large clients. But lately, let's just say last 4 or 5 years, they've really come of age. And part of the reasons why they really come into the mainstream, and these days, not a week really goes by without you seeing a press release of a major insurance or reinsurance company opening up a dedicated parametric trading desks and a broker getting into the parametric space. Part of the reason is that we have been in that proverbial hard market over the past number of years, right? Hard market is defined as predominantly because of extreme weather activity and catastrophes, hurricanes, quakes, tornadoes, you name it. There is a wholesale repricing, meaning that insurance premium go up, deductibles go up, coverage limits go down, and terms and conditions becomes very restrictive. And when that happens, businesses and people out of necessity are trying to see how else can I insure, right? What else is out there? And that's what brings into the table this sort of umbrella notion of alternative risk transfer, which certainly includes innovative solutions like parametric insurance, but it also includes some other tools like captive insurance and so on. And that's for another Spencer educational webinar. So in a nutshell, yes, regulatory climate varies even within the US. It certainly varies around the globe. The good news is that these transactions could be done many different ways. If insurance is an obstacle, then you can transact it as a financial instrument. Good questions, man.
Fantastic.
Any more
Yeah.
questions?
Yes, there is another
Let's
question in
do
the
it.
chat
Great.
from Yagna. If you're in a space, perfect. If you're in a space where you can just unmute yourself and ask your question, go for it.
Yes. Hello, Alex. So my question is that I heard parametric insurance can be given for coral reefs. So if yes, how does that work? And who will take the policy? Is it the government to restore the coral damage, or who takes it?
Fantastic question. By the way, this was one of the sessions at last week Toronto catastrophe event. There was a panel with Swiss Re folks, etc. And I also actually, participated indirectly in that panel. So yes, the question was that there was a notion that there was actually a transaction. In fact, there were 3 separate transactions that I'm aware of that actually cover coral reefs, right? And this is goes by the label of the so-called nature-based solution, right? Can you basically insure nature, right? And so the context there have been these transactions done in Hawaii, in Mexico, off the Cancun, and in South Pacific in Fiji. So, and in all of those cases, the asset being insured are the coral reefs. Why might you ask, why should we insure coral reefs? Because let's say in Cancun, that's a major attraction for the tourists, for diving, etc. And so if hurricane comes in and it damages the coral reef and it's not quickly rehabilitated, they will have a significant drop in tourism and attraction, right? And so in those particular cases, I think your question was, who takes out the policy? I believe in the case of Mexico, it was a consortium of there's some government players as well as, let's say, some of the hotels, which are the primary beneficiaries, right, of those coral reefs, that they effectively become the beneficiary. And I do believe, I don't remember the exact details, just simply because there's hundreds of the transactions like this around, sort of parametric transactions like this, maybe thousands, in fact, that's probably a better term. But the proceeds of a hurricane hitting that particular area where the coral reefs are, the proceeds go immediately to start immediate, effectively response and recovery and restoration of those reefs, right? In those cases, Cancun and I think Hawaii, you can almost think of the indirect beneficiaries or maybe even direct beneficiaries is really hotel operators, right? And the tourism industry, because they are the ones who are going to suffer if that vital nature resource is devastated. But yes, this parametric insurance on the nature-based solutions, coral reefs, mangroves, and things of that nature, that really is a cutting edge. That's one of the cutting edges of the parametric insurance use cases. So thank you for that question. We have another hand, I see, right?
Yes, go for it, please. Unmute yourself.
Thank you for the session. First of all, I'm Prerna. My question is, so from what I've learned from the session, parametric insurance is majorly applied for catastrophic risk and natural disaster. So with increasing climate risk, how is the insurer making sure that they remain profitable and also giving affordable insurance to the people?
Okay, wow, there's a lot to unpack there. Thank you for the question. So first of all, correction. It's not just for catastrophe risks. It's for general weather risks as well. We're talking about rainfall or drought or temperature or frost or, how strong or not strong the wind blows, how much sun shines if you're operating a solar farm, etc. So yes, I would say majority of parametric insurance implementations around the world tend to be focused on natural perils, either weather perils or disasters like, quakes, tornadoes, you name it. But there is also a growing breed of solutions of parametrics based on other metrics. And let me give you, well, there are many examples I can give you, but let me give you one, which is hopefully relevant to all of you, because probably most of you are in university of one sort or another. And I can mention name because it was sort of at least public information in the small circles. Before pandemic, University of Illinois in Urbana-Champaign took out a parametric policy, not for tornado, not for hurricane, but they realized that a vast amount of tuition revenue was coming in from their foreign students, India, China, etc. And somebody asked a very good question. What happens if, for whatever reason, geopolitical tensions, whatever, change in administration, what happens if we suddenly have a significant drop in foreign students enrollment? What is it going to do to our tuition revenue? So they put together a parametric policy which would have paid them certain amount if enrollment of foreign students dropped by certain amount, by certain percent. That policy, if memory serves, was put in place shortly before COVID pandemic hit. And you can probably get the rest, right? COVID pandemic hit, enrollment of foreign students went to zero. They collected full limit policy. So this is an example of non-weather, non-cat type parametric insurance. And let me actually just put it more generally. Remember, with parametrics, the data source, also known as a trigger on which the payment is made or not made, it's external data source, right? You're taking outside of the insured and insurer relationship. For weather events, it could be government or private weather stations. It could be you name it, right? But it could also be an index like, something that you can objectively, independently verify. How many students enrolled at our universities, right? Or something else. And so this is an example of the non-weather-based parametric solutions. But I think the rest of the question, because I can talk, as you could imagine, I'm very passionate about this stuff. But I think the crux of your question was, how do insurers make sure they're not losing their shirts on these types of contracts? Look, guys, fundamentally, at the end of the day, this is still taking risk. This is still insurance. The only difference, if I can trivialize it, the only difference when you're underwriting, let's say, traditional insurance versus parametric insurance is that for traditional insurance, you really need two inputs, if you will. One is frequency and the other is severity, right? So I kind of want to know what your loss experience was, right? Not only how many times you had a claim, but also how bad it was, right? So frequency and severity. For parametric insurance, you only care about frequency. You don't care about severity. Why? Because you do not underwrite, your particular house or your particular, plant. Instead, you underwrite a particular event. How likely is that a category 3 or higher hurricane is going to enter that circle over the next 6 months? How likely is that at your particular factory, the wind speeds will clock at more than 150 miles an hour? Therefore, for parametric insurance, you only care about frequency, not severity. And therefore, just like for other insurance, you do what prudent risk managers do. You assess the risk. You look at it in the context of your overall portfolio. You obviously build in some profit margins, etc., and you're off to the races, right? So fundamentally, this is no different than underwriting anything else, just with a certain nuances. So hopefully that addresses the question. But if not, by all means, please ping me afterwards. We can go deep dive. I think we have another raised hand there.
Yes, Andrea, go for it, please.
Hi, thanks for all the information so far. I was wondering, because it sounds like, parametric insurance is pretty great, all things considered. What do you think is keeping people in the traditional insurance industry of using, commercial property and casualty carriers? Why are they not switching over?
It's another great question. I would venture a few guesses. One is education and awareness, meaning that notwithstanding the greater publicity and awareness that these solutions exist, and not only that they exist, but some successful track record of very quick payments after some of the major recent headline-grabbing events, notwithstanding all of that, the typical reaction is parametric what, right? So there is still a bit of that needs to be done. Now, especially amongst consumers and especially in the United States, because paradoxically, the retail parametric solution aimed at smallholder farmers, etc., they're very, very popular in the rest of the world. They've been done in Africa since 2008 in a huge scale format where there would be schemes, scheme is a European term, which has a negative connotation in the US, right? Programs that cover hundreds of thousands of smallholder farmers. Pretty much, guys, every single continent, maybe save for Antarctica, there are multiple implementations of parametric insurance at an individual level, farmers, you name it, right? And so why it hasn't yet caught on an individual, sort of on a personal lines level in the US? Well, again, I mentioned a few examples of an earthquake coverage available, etc. I think part of it is, again, education awareness. Another part of it is, the power of status quo, right? You've been with State Farm for 30 years or Allstate, not to pick on them. They've taken care of you, etc. Why try something new and unproven, right? There could be a bit of that as well, kind of a status quo and inertia. But certainly, if you ask folks, probably more from a business community as opposed to individual homeowners and whatnot, those who embrace the parametric solutions, and especially those who had a very positive experience of the solutions delivering as advertised, it would be a very different story for them. So that's probably as best as I can answer. We have another question there.
Yeah,
Please.
yeah, thank you very much. So looking at it, so just want to ask if parametric insurance will be covering for cyber threat. Having said that, it covers for non-financial and physical, non-physical and physical. So just want to clarify that.
Fantastic. I'm glad you asked, Emmanuel, because as of about a few years ago, there is now a Parametric Cyber Solutions. They ultimately underwritten and backed by Lloyd's of London and some companies in Bermuda, but the way they work is it's primarily intended as an outage insurance. So, for example, if you have a small business that runs on Google Cloud or Microsoft Azure or what's the third one? Amazon, right? Yeah, the elephant in the room, Amazon Web Services. Let's say if your business is dependent on those resources and those resources go down for whatever reason, you suffer, especially if you're in the commerce business, you suffer. And so there is a solution brought by a company called Parametrics, X at the end. And they've been offering this parametric cloud outage insurance, which basically pays you after a certain period of time. Let's say maybe you have a waiting period of 2 hours, and for every hour of outage beyond that, you get paid pre-agreed amount of money. That you arrange before you take out the policy, so that there is no argument. And similarly, as with all parametrics, right, you can go to some websites and see, is this website down, right, and whatnot. So you're able to see as a customer that yes, indeed, I had an outage lasting 3 hours and 45 minutes, and the first maybe hour was my deductible, but everything else I get paid for in accordance with a pre-agreed formula, no questions asked, right? So yes, there is a parametrics for cyber. You had another question.
Yeah, so just want to clarify something. So looking at the parametric insurance, having after the laws are occurred, and you weigh the premium being paid by the consumer, it's not meeting up with the loss occurred. How would that be a loss to the insurance company, or how would they provide the coverage for the policy? Do you get?
So the question, I'm not sure I heard the question correctly. You were breaking up a little bit. So what is the scenario you're looking for?
Oh, I was like, what if, okay, for instance, the loss that happened at the Los Angeles, the wildfire that happened. So I'm looking at the insurance companies that are covered, people that have policies in the insurance companies, and the premium paid to the insurance companies does not meet up with the damages occurred. Won't that be a loss to the insurance company, or how will they cover for the policy?
Right. So he's basically asking, how do the insurance companies make money? Like, isn't it a situation where the risk and the loss itself outweighs, the premiums, the gains that the insurance company would have? So
Sure.
how
So
do
I
they
think
make money?
Sure. So I think this is maybe perhaps this is a broader question of not just specific to parametric. How do insurers make money? Well, insurance guys, you probably heard that in your classes. It operates on the law of large numbers, which means that you can certainly, if you have a decent enough pool of risks, you can be reasonably confident of what your sort of expected losses would be, and therefore hopefully generate a profit based on that. Now, of course, it doesn't always work this way. If you've seen some of the recent headlines, in fact, I think from yesterday, the National Flood Insurance Program, which is a government-owned program to facilitate flood risk in the United States, they've just tapped the federal, they just borrowed $2 billion, another $2 billion from U.S. Treasury, because all the premiums that they collected for flood insurance wasn't enough to pay for the losses from 2 hurricanes that we had last summer. Hurricane Helene and Milton. So that can happen. But in general, parametric is no different than traditional indemnity in the sense that, as somebody asked a question earlier, you use the same prudent risk management and sort of portfolio diversification techniques by different perils, by different regions, and this is no different in that sense.
Great
Have another question
question.
there.
Uh-huh.
And
Go ahead,
Alex, hey, I
Jonathan.
appreciate you taking the time doing this. I know we're running up on time, but I had a quick question on captive insurance. You mentioned that earlier. I don't know if we have enough time for it, but actually, we used to work with a company here in Dallas called Ryan. We self-insured keyman risk for a fund. And so I was just wondering if you could chat a little bit about y'all's product offering around captive insurance and self-insurance.
Okay, sure. Well, gosh, that's a challenge to do so in the remaining 9 minutes, and I want to save some. We have a couple more questions there, so let me see if I can condense it. So, guys, traditional insurance and or parametric insurance flavor of it, it comes in at a point where you decide to transfer the risk to somebody else. You just transfer it in a slightly different format, right? But there are also cases where such transfer is not possible, either because there are no insurance companies that are offering the product that you want to transfer the risk for, or maybe for whatever reason, you just have such a unique risk that nobody wants to take it. And so question is, what do you do then, right? And so the common sense is then, obviously, you retain the risk. You retain the risk on your balance sheet if you're a business. And the question is, well, how do you pay for it? Sometimes you can pay for it just out of your regular cash flows because, I doubt every single one on this webinar, has an insurance against, spilling ketchup on your shirt. Because if that happens, you're just gonna, pay whatever $10 and have it dry cleaned, right? You don't purchase insurance for that. However, for something much more significant and sizable, companies can either, if they self-insure and they cannot find ways to transfer the risk, they can obviously pay it out of their cash flows, or they can be something more formalized. Maybe they can set up like a rainy day account, or, and this is what I'm coming to, Jonathan, questions, they can also set up its own insurance company. That's why it's called captive, because it's an insurance entity licensed, with a certain tweaks, and owned by the company. So it's a more formalized way to retain the risk on your own balance sheet. It does have a number of advantages. We not nearly have enough time to go into them. I'm happy to do another Captive 101 on another webinar, but fundamentally, it's a form. And let me just give you one other educational example to bring it home. Some of the captive insurance companies that corporations own, they are much larger than traditional insurance companies. And I'll give you, there is no better example of that than University of California, which has at least 3 captives, which cover everything from employee benefits to all the buildings and dormitories in their campuses, to all the, expenses of repairing and replacing the Xerox copier machines, right? You can be incredibly creative with that. And in fact, here is a connection. Thank you, Jonathan. That was a nice cue, because University of California recently announced the parametric earthquake transactions where they equipped, I forget how many, but I think we're talking about hundreds of buildings across different UC campuses. They equipped them with an earthquake sensors, and they took out parametric earthquake policy, which will be based on the building specific shaking as measured by those sensors. Anyways, there is a lot to cover there, but I think we had Kasoki. Sorry if I butchered your name.
Yeah, thank you so much. My question is, with parametric insurance, how do insurance go about moral hazard loss control? Because I know when this trigger happens, I'll definitely be paid. How do insurance companies go about loss control and moral hazard when trading parametric insurance?
I apologize. There wasn't a good quality line there. Tandaka, did you hear the question, if you wouldn't mind?
Yeah, so I think it's about loss control, right, Kasioki? Your loss, how do you, right? So what do they do in terms of loss control for this type of insurance?
Sure. Look, so this is similar to what we briefly touched on before, is that you treat that risk just like you would any other risk. You may have controls, for example, on how much parametric earthquake policy you want to write in California, just like you would have some risk limitations or aggregations around the same if you were doing it on a traditional basis. And so obviously in the context of diversifying risk, maybe you create a well-balanced portfolio where you have earthquake risk in California, earthquake risk in New Zealand, typhoon in Japan, tornado in Texas, whatever that is, right? But I think the principles of loss control, they are not something that is unique to the type of insurance you have, right? Because at the end of the day, you're taking on the risk on your balance sheet as an insurance company. It's in a slightly different format, but it would be subject, or it should be subject to the same type of a risk management architecture. Edward, you had your hand up.
Yes, thank you. My question is, from what I'm gathering, I feel like parametric insurance is more like they've taken the business model of life insurances, where the sums assured are predetermined at the inception of the policy, and that is being applied to property and casualty. Am I right? Is that the case? And my second question is, what are some of the instances or situations where claims are denied under parametric insurance?
Wow, two excellent questions with 4 minutes to spare. All right, let's try to split it evenly. Is it good to analogize parametric to the life insurance? Especially, I presume you're referring to the maybe term life insurance or regular whole life insurance. So I've heard that analogy and a few times before. I guess where I would draw the line by saying not exactly is the fact that in life insurance, yes, even though, not to be morbid, but the outcome is pretty binary, right? The reality is it is not adjudicated by some independent data from Social Security Administration or somebody else. It is still, there is still paperwork where you have to submit proofs to the insurance company, and right. So in that sense, there is still the loss adjustment process that we have, right? Except presumably it's not maybe as involved as in a property and casualty, but because there is still a bilateral relationship, right? There is insured and there is an insurer. There is no third-party independent entity there, right? And so because of that, I would say this is not a parametric, but it comes close. And your second question was, sorry, what was the second question? I forgot.
My second question has to do with some instances or scenarios where claims are denied.
Yes, denial of claim. Okay, so by definition, because the payment trigger is objective, right? And there are no secrets. Insurer can see it, you can see it, right? Almost by definition and by design, it significantly reduces the risk, right? Oh, you denied my claim because of, because you were biased towards me or whatever the case might be, right? You can't really say because the claim was based on the wind speed as measured by National Hurricane Center. This is the data right on the website, right? Is there a bias there? I mean, so look, I'll tell you this. There've been very few, I just literally can think of it on the fingers of my hand. There were very few instances where there were some disputes around parametrics, and mostly because there was something happening with the data provider, right? Was that independent objective trigger, whether it was an outright fraud or whether it was like a malfunction or something like that. But by far, this is almost a non-issue by design, right? Because you remove all the subjectivity in loss assessment and make it completely transparent to both parties.
Thank you.
You're welcome.
Fantastic. So we have about a minute left of this session. So Alex, did you have any final thoughts, comments, anything as we wrap up this session?
Guys, I barely scratched the surface on parametrics today, as you probably could imagine, and I didn't even have time for some interactive session with you on different industries and give you the different examples. Obviously, as you could see, this is a subject that we can talk about for we can fill many webinars. So I would encourage you, number one, if you have any follow-up questions and whatnot, connect with me on LinkedIn, and I'll try to respond to your questions there. And sort of personally, I hope that, especially for those who were not exposed to parametric insurance concepts or maybe even captive, thanks to Jonathan's question there, well, hopefully you know a little bit more after this webinar, and hopefully that will, maybe open up some horizons and get you thinking along certain ways how to mitigate risk and how to efficiently use this tool in the risk manager's toolkit to narrow the gap and to effectively make individuals, businesses, and society as a result more resilient. So certainly, if that would be the ultimate, the ultimate prize for me personally, right? Just so you're aware that there is this tools. And again, as I mentioned to Tandeka in preparation of this event, it is my firm belief that every one of you who is coming out of risk management and insurance educational programs, you would be very well served by being aware of these tools, parametric, captives, structured insurance solutions, because I firmly believe we're just in the early innings of this game, and they will become very, very important and much more widespread, hopefully sooner rather than later. So that's my closing statement, guys. I appreciate you listening and tuning in and spending an hour with me.
Fantastic. And as you all heard, he is welcoming you to add him on LinkedIn. So we did put his URL in the chat box. Feel free to click on that, add Alex on LinkedIn. And if you have any additional questions, please feel free to ask via that medium. As previously mentioned, we do host these sessions monthly during the spring semester. So our next session is going to be Thursday, March 13th from 1 to 2 Eastern. Our presenting organization is going to be SRMC, which is the Society of Risk Management Consultants. We're going to have 2 Spencer Scholar alumni that will be our guest speakers, and they're going to introduce us to the world of risk consulting. So be sure to click on the link that's in the chat box as well and register for the March session. So with that, Alex, thank you again for being here today and for hanging out with us for an hour. This was very engaging. This was very informative, and we appreciate your time.
I appreciate it. And guys, as I was just quickly skimming through the chat, I see that there were a lot of questions. Hopefully, maybe some of them were not answered. In case your question was not answered, by all means, just forward to me on LinkedIn and we'll address it there. Thank you very much again. I appreciate it.
Thank you. We appreciate you. Enjoy the rest of your day.
Bye-bye.
Thank you.